Hey, good evening, everyone. Marty Missouri here. It's after hours on Tuesday, 8/8/2023, with your midweek market snapshot. Clients, I'm going to send this to you, link to an email tomorrow morning. This will be the Wednesday morning message. Not a ton has developed in the technicals, meaning same patterns, breakouts below rising wedges as were to be expected. I did add back the 20-day moving average. We'll talk about that for a minute. Only going to focus on the daily charts of the S&P, of the NASDAQ 100 ETF. For the third time in a row, I think I will feature Amazon and Apple only because I've done that lately and I want to show you how those two are playing out currently. May quote myself from this morning's written blog, and I may show you a couple of charts to make a point about the unique environment that we're in. So without further ado, in front of you is the daily chart of the S&P 500, and I don't want to show the momentum indicators just yet. I want to show you that we did break below a bearish rising wedge pattern, have not come back and retested anything yet, have a little gap right here that may very well get filled. That would be the market rallying back. The yellow line is the 20-day moving average. You may recall we've featured this a few times on the videos because it's been a real important indicator during the life of this bear market so far. When the market has broken, this is before the all-time peak, the 20-day moving average of late, this is a simple moving average, you tend to get some pretty good corrective action at a minimum. Here was a false break and then bounced back, danced around it a little bit here, but when you break it with some momentum, you tend to see some pretty decent declines. In this case, we're talking, a nice 15% decline. Saw a nice bounce, recaptured a good chunk of that, and then came down and lost it again. And what I'll do is I'll go to the peak that preceded the losing of the 20-day moving average. Good for an 18% decline. Came back, be consolidated right on 4,100, and that was basically a failed breakout. So if you want to just take this one all the way down, that last leg from the first break here was 21.5% decline for the S&P. Then the market bounced right off of that level, just above 3,600, had a nice rally back to the tune of about a 20% rally, came back, lost it again. You get the picture. So that 20-day moving average has been important. There's another 20-ish% decline right from there. Probably a 9-10% decline right there. Broke it again. So it got kind of choppy in here. And here we are holding right in there at 4,100. And this was really where we came bouncing off. And I'm going to call it on the AI craze, and we're going to look at something related to that here in a minute. So here we are, folks, breaking below the rising wedge pattern, below the 20-day moving average, dancing around it, coming off of that a little bit more today, amid a sell signal on the MACD, coming off of overbought levels, nowhere near oversold at this point, with with our bearish divergences. Now, could this all be a false signal? 100% it could. CPI this week could come in soft. Market would love that. You get later in the month, and if you get another just bang on or blowout earnings report from Nvidia, then we could get another big AI fueled rally before this bear market ultimately finishes playing out. We do think there's uncomfortable odds that there's another leg down. What I preached today on the morning blog, though, is kind of stay away from the pundits right now in this environment who are either full-on bearish or full-on bullish, because I just think that is the height of irresponsibility. There is a bullish narrative. If you didn't read the morning note, please do that. I borrow a bullish policy, monetary policy centric narrative from BCA. Analysts laid out a pretty good analysis, I think, a legitimate narrative. And then another one said, you're crazy. And here's why that doesn't make any sense. And that was the bearish narrative. I think they're both very plausible. I think the pathway to a soft landing or no landing is a very narrow pathway, but I do think it's possible. So anybody who's just outright bearish and playing the downside right here, particularly if they're dealing with other people's money, I don't think they're being responsible. Anybody who's just full on bullish and just so badly wants to believe that bullish narrative, I think that's equally irresponsible, if not worse, because if this thing does break, that could be very problematic to the downside. A second leg down in a bear market can be really, really messy, and I've experienced this firsthand over the last 38 years more than once, I can promise you. So that's your S&P, QQQ, the ETF that tracks the NASDAQ 100 index. Same look, the importance of that 20-day moving average. You can see big decline when it broke, nice rally when it broke back above, big decline when it broke below, so on and so forth. Some consolidation in here, breakout with some momentum, big rally, decent correction, and then we were off to the races. Here we're breaking down, retesting it. Looks like we're losing that right now. And recall that I've been telling you this one looks more dangerous to me than the S&P, partly because it is more concentrated in those, magnificent 7 stocks they're calling them now. Used to call them the FANG stocks. And that's where this rally has been very confined to at least until recently. You had these, long moving bearish divergences, sell signal there. So, right now this is playing out pretty bearishly, 100%. You could argue that there's some really strong support right there. I mean, look at that. That goes back at 370, right back here. So lots of action there. And, we could bounce off of that and, could ultimately overcome those fall of 2021 all-time highs. Amazon, remember we had this rising wedge, we broke down, had those blowout earnings, but all we did is come back and find resistance at the previous uptrend line. Not a good look. Remember we talked about the likelihood of that, and that important for Amazon bulls that we break back through there. So right now we've had 1, 2, 3 days or so of failing that. We do have this gap here, and I ran this one a little further back for tonight to show you that we've worked on this in the past. Here we were, that was the end of April, so all of May, all of June, all of July. So this is 2022. 3 months later, we finally filled the gap, came up, and then promptly rolled back over. Gap lower here in October, and it took all the way till early February to fill that gap, but then that was resistance right there at the top of that. Lost that again, danced around the line here. Boom, nice big gap here. I suspect there's a good chance that that gets filled at some point before we're ultimately back off to the races, but again, time will tell. There's a lot that could come in. I still think there's enough of the dip buying mentality before ultimately these things really do fall apart, if indeed they're going to. But you definitely don't have the momentum that goes with it. So technically speaking, that's just not an optimistic look. As for our good friend Apple, the biggest company on the planet, really broke down. Again, we were looking at this when we were up here in this channel against these bearish divergences, began to roll over, and that thing has really popped to the downside. Not good that it's closing below 180 right here, although barely by 20 cents. So there's not nearly enough here to pile on the shorts if 180 was an area that we were looking at. You get below that very far for very long, and some stop losses are going to hit, and then we're looking at 170 pretty quickly. Okay, so remember I've been talking about, or speculating as to why this market has done so good this year against what are, potentially some pretty problematic fundamentals. I think are problematic fundamentals. Hedgeye this morning in their morning macro call kind of poked some fun at the whole AI story, and I borrowed this chart from their presentation. It's just basically looking at what tends to be bubble mentality. So this is AI news story mentions, AI mentioned in news stories, company transcripts, conference calls. How many times was AI mentioned? Just straight up in a straight line. And of course we talked about that being one of the factors that kind of kept this rally alive, and it all started pretty much with NVIDIA's earnings, at least the last big thrust here. I've talked a lot the last year or so about the influence that the tail is having over the dog, so to speak, with just monster volume and options. We're talking monster call volume this year, and what happens when you have that much of pressure to the upside is it gets exacerbated as the dealers hedge that risk. They do their gamma hedging as the things continue to go in the area that they're short. So there's a level, supposedly according to the people who are experts in this, that is too close for comfort here, that if we did get some sort of a precipitous fall, this dynamic, this gamma hedging dynamic flips and you could get something precipitous to the downside. I'm not predicting that that's going to happen. It's just that the risk is there right now. And so we've got to remain on our toes, and I think we have to remain hedged. Another point that Hedge I made this morning is a point that we made exhaustingly here over this year, particularly early in the 2023 rally, and that is the very narrow breadth. So here's just Apple and Microsoft's percentage of the S&P has gotten to nearly 15%, and that is just kind of breathtaking, and it's too reminiscent of the concentration of this market in late 1999. And then they show you a ratio of the NASDAQ 100 equal weight to the NASDAQ 100. So basically the NASDAQ 100, which is just completely choked with these names and a few others, versus what happens when you just give each position 1/100th of the pie. And you can see just the dramatic difference in performance. And that's just weak breadth. And we've talked a lot about that. And it's actually improved some of late. Whether it plays out and the big blizzard hits, this is just a very risky setup. If I may be so bold to quote myself from this morning's blog post, the problem for the unsuspecting investor is that in the land of financial pundits, there, alas, seems to be an unwritten rule that says they got to pick a side. And when they get on CNBC, it's as if they're campaigning on behalf of whatever bias they may have. And man, can that be convincing. I.e., you got to be bullish or you got to be bearish. Can't be both, can't be neither. Well, frankly, I reject that notion strenuously, that you can't be neither. Under present circumstances that we've been illustrating over and over again, and given that both narratives possess plausibility, I won't read the narratives to you, go to my blog if you'd like to read them. If we're talking folks like us who are tasked with caring for other people's money, it is grossly irresponsible. If not, I'd say in fact it's negligent to pick a side right here. In our view, the only prudent path, until we have more clarity, is to diversify in a manner designed to capture a chunk of the upside should the bullish narrative play out, and to mitigate a chunk of the downside should the bearish case ultimately take hold for whatever's left in the cycle. So you cannot have it both ways. If you want to squeeze out some gains in the world of financial markets and securities while the market goes up, you're going to have to take some downside risk. If you want to mitigate some of that downside risk, you're not going to be able to capture full on, the bull market move because, again, by definition you won't, because you're playing defense. You're doing some things that either will go counter to the move in the market, like buying puts on the S&P, or things that would do well in a kind of a recessionary scenario. When interest rates are plummeting, perhaps, and that would be gold, would be a defensive hedge, long-term treasury bonds, that sort of thing. So a good balanced portfolio right here, I think, captures a number of potentialities within its positioning, and that's the best you can responsibly do in the environment that we find ourselves in right here. As for the environment going forward, it will evolve, it will change, forecasts will clear, or the worst will happen in terms of my blizzard analogy. And then you get an opportunity to buy the stuff you really want. And we have quite the shopping list when we get there, or if we get there. But you wait. You wait either for the forecast to clear, for fundamental conditions to improve, so you're comfortable taking on some more exposure, or you wait for the things you would take on to get really, really cheap to the point where they're oversold, and then you do it then. So you might argue that the latter is the better, although you suffer some downside in your existing long positions in that scenario. Folks, thank you for sticking with it that long, and I will talk to you again very soon. Take care. Bye-bye.